Hi, everyone. During these volatile times, Jim and I thought we would send you a short update to give you some perspective.
Stay tuned.
So, we're in a bear market for stocks. Stocks are down more than 20%. Unfortunately, this is a year where the bond market is doing as poorly as we've ever seen. Um, Investment grade corporate bonds are down more than 20% as well. So, if you have a balanced portfolio, it's a real challenging year. So let's talk about recession. This is something we hear about every day now, and there are a lot of people who think we're in a recession. There are a lot of people who don't think we are. Those people, most of them believe we're going to see a recession in 2023. Regardless of whether or not we're in one now, the market doesn't really like what it's seeing. They don't like the rising interest rates, which are necessary, by the way, to combat inflation. But the market is not liking what they see in the future, and that's why these prices are all falling. Now, recessions are just a natural part of the business cycle. We've had 11 of them since 1950. They all were followed by really nice expansions. But what's interesting to note is they're relatively short. They go from 2 months to 18 months. The average recession since 1950 has been 10 months. The stock market bottoms before the end of a recession. And so that's why it's difficult to try to market time or make drastic changes um, during a recession, because you want to be in the market when it bottoms so you can take advantage of the upside potential from that point. And once the recession ends, you want to be in the market for that expansion. The bear market that we're in now, we're in it. This is the 10th month. On average, they last about 18 months. So the good news is, we're not at the beginning. The bad news is we may not be at the end, but we do think that we're pretty close to the bottom. We might see more decline. We'll probably see a lot more volatility, but we think there's a reasonable chance that we're pretty close to the bottom. So it's important to have as much patience as you can. Think longer term. 2 years, 3 years from now, there's a real good chance you'll look back and you'll be really happy that you stayed the course or you even added money at this time. So those are some of the comments that we would want you to keep in mind.
One thing that you can do right now during these falling markets is to determine how does everything going on right now affect your long-term plan, and ensure that you're still on track to pursue your financial and retirement goals. We know that over the course of one's retirement, we're going to have bull markets, we're going to have bear markets, and we build out our projections, our retirement projections, with these kind of markets in mind. So it's really important during times like this to fall back and stick to the financial plan that we designed together. We're meeting with clients over the next few months to do exactly that. Take a look at how these markets really affect your big picture. So if you haven't already, we'd encourage you to reach out to us about retirement planning. We can look at the projections over the next 10 years, 20 years, 30 years, and really identify where you're at and where you want to go, and sort of how all these markets really play into the big picture. Thanks, everybody, and I hope you have a great rest of the week. Take care.